Good morning, everyone. Are you able to hear me clearly? Good morning, Rahul. Yes, I believe all of you can hear me clearly. Good morning, real accountant. How are you? Let everyone join in. We'll just start off in a minute's time. Good morning, Lokanathan. Good morning, everyone. So, friends, today we are going to start with our unique 15-hour marathon. The main objective of this marathon is to give you maximum coverage of all the chapters in a very short span of time so that you all can score maximum marks in minimum time. Good morning, Shraddha. Good morning, Megha, George, Linda, Renisa, Sridevi, Prami, Subhakar, good morning everyone. Very happy to see all of you attending this session right now. So friends, today's session as I told you is to revise the entire AFM in a very short span of 15 hours of time, for which I have made a new comprehensive material, and this material will be used for the purpose of the classes today. Alright. So I believe everybody has joined in. Can we start off with today's session now? Please type a yes in the chat box. Yes, fantastic friends. So let's start off and let's not waste further time. So first I have given you some limited very good questions from each chapter which we will work out. We will some questions which are very easy we may discuss, but I don't think we have any easy questions over here. Others we'll work out together in the class, and once that working out part gets over, then we will go to the second part where if we get time we will discuss the RTP also. Alright. So let us start with this 15-hour marathon, friends. First chapter which is important for all of you is the bond valuation chapter. Even before I start off with today's session, friends, let me just give you a study plan first. One minute. Yes. So when we talk about your AFM study plan, I'll break it up into three parts. One, which is going to be theory. Friends, for this theory, I have already incorporated a theory marathon in my application, which actually can be used by all of you. One moment, friends. One moment. Okay. So we already have a theory marathon that is incorporated in my app, which has a duration of only 3 hours of time, 3 to 4 hours of time, in which I'm revising the entire theory of your study material. That can be part 1 that you can refer. Part 2 are certain easy scoring chapters. Now, when I say easy scoring, what I'm trying to tell you is that in a limited short span of time, you will be able to score a lot of marks. And some of those chapters are bond valuation, you have mutual funds, you have mergers, you have valuation, then you have capital budgeting, and then you have the small topics like value at risk and security analysis problems. Okay, these are the topics that should be given priority before the examination, because this will cover 60 to 70% of the marks from the examination point of view. Then you have some tough areas. Now in this tough area you have portfolio management, you have futures, then you have options, you have interest rate, derivatives, and finally you have forex. I would say go with portfolio and futures first. Finish these two also, because you will have one sure short question from portfolio, one sure short question from futures, and they are manageable. Remaining areas also you will have one question each, but the time taken for the last 3 chapters will be vast. That's why in my mentoring program, I'm not sure if you're a part of that mentoring program. In my mentoring program, we actually spent, this we did it in the month of September itself. We did not keep it for October, because last minute these chapters can create a lot of pressure for all of you friends. So take a minute, quickly write down this in your books, with which I'll go to the next part of problem solving. I share this handwritten notes with all of you friends. So your objective should be scribble and solve so that we get more time. If you are getting more time, we can crack more amount of questions. Am I right? All right. Now, can I go to the next part? Right. So friends, the study plan is clear. With that study plan, let us start off with today's first question, which is a question on bond valuation. All right. So we have already learned about bonds. Bonds are debt securities that are issued by government. All right. Government of India bonds are there. There are a lot of zero coupon bonds are there. Treasury bills are there. All these are bonds. So when we speak about a bond, one thing that we always know is that a bond is risk free. They give you assured returns, which is called as the coupon payment. And apart from this coupon payment which they pay you, the expectation that the investor has is called as the yield. And I have already told many a times in my classes that value of a bond is nothing but it is the present value of future cash flows that the bond can actually generate. So considering all these points, we are going to crack a question on bonds. Friends, I have given you the solutions also over here, okay? But we'll scribble and solve it a bit quickly so that we all can get the answers also together. You can work out yourself and you will get good exposure in these all the areas. All right. So let us start with the first question. And as I tell you always, whenever we start any question, we have to start with working note number one. What will be working note number one, friends? It will be the basic data. Okay. So now when you speak about basic data, what do we do in the basic data? We copy down all the numbers in the basic data so that in minimum time, everyone can understand the question, and the better you understand the question, the better you will be able to write the answer and get the correct solutions for each of this. So let's start with the first one, face value. So I'll write down point number A, face value. How much is the face value? It is 10,000. All right. Coupon rate. What is the coupon rate that is told over here? Coupon rate is told as 8.50 percentage. Am I right? And what is the life for the years to maturity? Life turns out to be how many years? It turns out to be 5 years. All right. And what is the YTM that is told over here? YTM is told to be 10 percentage. From this, they want you to find out the current price of the bond. They want you to find out the Macaulay's duration, volatility, and convexity. So what I'll do is you keep on writing along with me. Okay, scribble and write down. I will write down working note number 2, duration of the bond, and what is the other thing that comes over here? And price of the bond. Okay, so here I'll draw a table. Here, cash flow, discount factor, discounted cash flow. Then we have to put weight. And when I do life or year into weight, we will get the weighted average duration. Am I right? So tell me, life is 5 years. Coupon rate is 8.5%. From that, can I find out how much will be my coupon amount? Will my coupon amount turn out to be 85? So year 1, 2, 3, 4, 5. Year 1, I will get 85, 85, 85, 85. And how much will I get in the last year, friends? I will get 10,000. Is it 85 or 850? Please help me and correct me if I am going wrong somewhere. I don't know where I have kept my calculator. Can somebody please help me out? I think it's 850, right? 100 into 8.5 is 85. So that's 8.5 thousand. 10,000 is 850. Yes. And last year it will be 10,850. Am I right? Okay. Yes. Karthik, I have shared the PDF notes in the WhatsApp group that has been already created. Are you a part of that WhatsApp group? The discounting factor is turning out to be 10%. So you have a discounted cash flow over here. And from this, you can find out the duration also. I will now give you 5 minutes time. Quickly solve this part on your own. In the meanwhile, I'll search for my calculator also. One moment, friends, one moment. Okay, I believe you all can hear me now. Right. I think I'm more audible now in both the places, right? Okay. Please write down now, friends. Please write down. Yes, friends, come on, tell me what is the answer you get over here? Put the answer in the chat box. The moment I see the answer, I'll go to the next part. Come on, quick. I hope my audio is absolutely clear to all of you, right? Fantastic. So, do you get the what is the price that you get, Rahul? Here you get 4.252 years. Okay, and what is the price that you get over here? Do you get the answer as 9431.50? Perfect. Friends, those of you who haven't got it, don't worry at all. I'll show you the solution here. We have done the whole solution in your workbook also. Okay. They have put the basic data and they have got the same 9431.5 over here, and they have got 4.252 years. Exactly the same answer is available over here. Alright. But I just didn't want you to rush up. I want you to scribble and solve it yourself so that the class can become useful. Otherwise, it will just become dictation and finishing it off. Alright. Fantastic. So everybody got these two answers, correct? Now, even if you have missed out or you're still writing, don't worry. This answer book is already shared with all of you in the WhatsApp group. If you're not there in the WhatsApp group, just message me. I will share the WhatsApp group link with all of you. Okay, right. So we are done with the first part and we have got the duration. The next part is called as volatility. Everyone tell me what is the formula for volatility? Volatility is calculated using the formula duration divided by 1 plus yield. Okay. So what is the duration that we got over here? Did we get the duration as 4.25 years divided by 1.10? So when you do 4.25 divided by 1.10, we get the answer as 3.86 percentage. What is the logic of 3.86 percentage? It means for every 1% change in yield, price changes by 3.86 percentage. This is how it should happen, but in reality, does it happen like that? No. That is where we come to the next concept, which is called as convexity of the bond. All right. Can you all please write down this in your books now? I hope my audio is very much clear to all of you, friends. If you are facing any audio issues, please do let me know. In reality, does it happen like that? No. That is where we come to the next concept. Okay. I believe I'm audible. Everybody clear with this part? Can I go to the next one now? Okay, so once you get the answer as 3.86 percentage, I will go to the next requirement of the question. Now they are asking you, after finding volatility, they want you to find out what? Convexity of the bond. I will explain this with the help of a logic also. And they are asking you, what is the expected market price if there is a decrease in the YTM by how many basis points? 200 basis points. So I'll do one thing. I'll write down the next one. Impact of impact of price if yield changes by how much? 200 basis points. Alright. Friends, 1 minute. Sorry for the interruption in between. I just need to make a small change before I proceed with the class. Please confirm that the audio is clear to everyone, right? Fantastic. Alright, fine. So shall we continue with this part now, friends? Alright. So friends, here what I'll do is I'll draw a table now. Here, cash flow, discount factor, discounted cash flow, discount factor, discounted cash flow. So what I'll do is here I'll put 10 plus 2%, that is 12. Here I'll put 8. So I'm putting 10 plus 2 and 10 minus 2. They have asked only for one part. I think in the question, what have they asked over here? They're only asking if there's a decrease, but I'm doing both decrease and increase because of a concept called as convexity of the bond, friends. So here, let us say year 1 to 5, you are paying 850. Am I right? At the end of year 5, you are paying how much? 10,000. Can you quickly do this and tell me what is going to be the answer that you get over here? How much price you get for the first one and how much price you get for the second one? Yes, friends, please do it. Rasika, it's already shared in the WhatsApp group. Can somebody please put the WhatsApp group link over here? Rahul, fantastic. You get 8734.25 for 12%. 8734.25. Simini, good speed. And inside rounding difference, that's okay. That's fine. Please do the other one also now, friends. $10,194. Fantastic, Rahul. Let others also complete. 10,194. I'll wait for a minute more. 10,204 is it? I think I remember that number better. 10,204. I would not say 10,194 is incorrect. It's just a rounding off difference. But from your textbook number that I remember, it's supposed to be 10,204. Okay. Now, everybody clear with this part? Now I'll just quickly show you the solution over here also, friends. You would have got the same number. Yes, 10,204, and you get 94318733. Is that the number that you got over here also? Yes, we got 8734. Fantastic. Once we get this answer, okay, we are going to write down the next working note heading, convexity. I would like to explain this to you using using two methods. One is I'll put a heading called as price using intrinsic value method, or that is nothing but DCF method. In bracket we will give it as DCF method. Second one is called as price using, what is the second method that we have? It is called as volatility method. Price using volatility method. Alright. Now here what I'll do is first I'll put 10%. At 10% our price is turning out to be 9431. This is what I'll call it as V0. Then I will put below that 12%, and finally I will put 8%. So 12% is what we will call it as V minus. That's because the price falls down. 8% we'll call it as V plus. You can instead say V plus for 12 and V minus for 8. Nothing wrong in that. You can put it however you want. Okay. Now, so how much is the V minus? I have 8734. And what is the V plus that we have? 10,204. Okay. When I come to volatility method, we have already found out earlier that the volatility is 3.86%. That would mean here, if it is 9431 minus 3.86% into 2. Why? Because for every 1% change, the price is going to shift by 3.86%. Correct? So you get 7.72%. You get 8703. 8703. Okay. What about the second one? 9431 plus into 2. You'll get 10,160. Once we put this, I'll put the formula here. The formula that they use is V plus plus V minus minus 2V0. Okay. Shall we do that for both the things, and you will understand why I'm doing all these things. That's when the logic actually connects. Alright. So here the formula would be V plus is 10,204 plus 8734 minus 9431 minus 9431. When you do, you get the answer over here as 76. But when you do 10,160 plus 8703 minus 9431 minus 9431, you get the answer over here as 0. Then I will put the base. The base is from what? It is 2V0 because we are taking 2V0 over here. The base is 2V0. So what is 9431 into 2? 18,862. Alright. So once we do it based on this one particular base, we get the convexity as 0.40%, and here it will turn out to be 0%. Okay, now logic I'll tell you in the next page. First you quickly write down this. I'll give you a minute's time. I hope you are clear with this concept, friends. This logic is not available anywhere. I'll explain the logic to you once you're done writing this. I think I'm hiding the screen a little bit, is it? Hold on. Okay. Okay, friends. I hope you're all clear with this part now. Okay, so we are clear with the numbering part. Now let us understand the logic. Friends, when you took volatility method says that exactly the price will go up by 3.86 or falls by 3.86%. When we do the formula of V plus V minus 2V0, exactly when you do it like this, your net differential turns out to be how much? 0. So volatility says that if there's an absolute plus percentage or absolute minus percentage, the net deviation will be 0. But in reality, do I get that exact 0 over there? The answer is no. In reality, I get the deviation as how much? 76. That means compared to volatility, the real method is deviating by how much? By 76, and hence you get the convexity as how much percentage? 0.4 percentage. Or the logic of this 0.4 percentage is that even though 3.86 percentage is the desired volatility or is the expected volatility or the expected deviation, I'll put the word as expected deviation. Actual deviation will be either between plus 0.4% or minus 0.4 percentage. So what is 3.86 plus 0.4? Do you get the answer as 4.26 percentage? And what is 3.86 minus 0.4? That is going to be 3.46 percentage. Or the logic is that the actual deviation will range between 3.46% to 4.26 percentage. Can you please write down this in your books now? Sorry for the interruption again, friends. I'm facing some difficulty with the hotkeys. 1 minute, friends. I'll just settle this once and for all now. Just 1 minute, friends. It will be sorted out right away now. All right. Yes, friends. Can you please write down this? So sorry for the disturbance, friends. Now there will be no more disturbance from here onwards. Okay. Please quickly write down this in your books. Perfect. So friends, we are done with this one particular question. Karthik, please WhatsApp me. I'll share my WhatsApp number. There's a WhatsApp group in which we have shared the document. Please WhatsApp here, and you will be given access to the classes, the material. All right. Yes, friends. I believe you are all done writing this in your books. Can I go to the next part now? Okay. So we are done with the first question, friends. I think they got 0.395. We got the answer as 0.4. All right. Fantastic. So I think they got all the answers that we have got, and we have done with this problem. Now we will go to a second question, which is another beautiful question on mutual funds. Friends, under mutual funds, we have different types of plan, such as dividend plan, then we have bonus plan, and we have a plan called as growth plan. This was one of the questions which came recently, where they have put a beautiful question mark. Because of this question mark, our life becomes miserable, because they have given you all the details, but they haven't given you the opening NAV at which investment was made. So when you get a question like this, we have to start from this table. So what I'll do is I'll write down question number 2. Working note number 1, basic data. I'll write down dividend plan, bonus plan. Right? Point number A, it will be the investment. So what is the investment that you have in the first case? Do we have 9,20,000? And in the second case, we are having an investment of 10 lakhs. Am I right? Profit is given over here. They have given the average profit. I'll from that work out the total profit. So 27,748.6 is the profit for 1 year. The total life given in this question is from 1/4/2015 to 31/3/2020. So total life is how many years, friends? 5 years. You'll get 1,38,743. Okay. And the other one is 6.4 percentage. So it will be 6.4 into 5 years, 32 percentage. 10 lakh into 32 percentage will be how much? 3,20,000. So I'll put it over here as 10 lakh into 6.4 percentage into how many years? 5 years. So from this, friends, can I go and find out the closing value of investment? Okay. So what is 9,20,000 plus 1,38,743? Do I get the answer as 10,48,743, friends? Keep on scribbling down along with me. And what is 10 lakh plus 3,20,000, friends? That will be 13,20,000. So once we get the closing value of investments, we have the closing NAV available in the question. That is 49, and the other one is 44. 49 and 44. So what I'll do now, 10,58,743 divided by 49. I'll get the closing units as how much? 21,607 units. And the second one will be 30,000 units. Can you please write down this in your books now? Yes, friends, are you all done writing this in your books now? So once you get this answer, I will go and do the analysis of the first plan. What is the first plan that we have over here? The first plan is called as the dividend plan. So we'll have to put all the details of the dividend plan over here. First column heading will be date. Okay, so I'll put the first date as 1/4/2015. On that date, you are having dividend percentage. Then you have NAV is given. So hold on. 1/4/2015, 31/3/2017, 31/3/2018, 31/3/2019, and I think it is 31/3/2020. Dividend percentage is 31/3/2019 is 12%. Okay, 2018 is 10%. Hold on. 17 is 12%. Sorry. Okay. What next have they given over here? 2019 is 15%. Okay. Now, opening units, I don't know. Based on this dividend amount, I don't know. Okay. Based on the dividend amount, we will have the units reinvested, which for time being I don't know. But once I get the units invested, I can go and find out my closing units. Am I right? So what I'll do is I'll put some underline over here. Alright friends, so now what I'll do is I'll start from the first part. What is the first part that you start from? That is 21,607 units is the first part where we know the closing units, correct? Here, is there any dividend percentage declared? No. If no dividend is declared, your opening and your closing units will remain the same. So the same thing will become the closing of the previous day. Now here I have a 15% dividend being declared. I don't know the opening units. So what I'll do is I'll come on the next page and put a formula. Whatever is my opening units plus my dividend amount divided by whatever is my closing NAV ideally will give me my closing units. So if my opening units is 100, I have a dividend of another 100. NAV is 10. So I reinvest the 100 at 10. I'll get 10 units plus opening 100 will give me 110. Here I know my closing units is 21,607. Opening I don't know. Can I call the opening as X? On this X, there is a face value of 10 rupee and they have given you a dividend rate of how much percentage? 15% divided by the closing NAV. So I believe the closing NAV is available. Okay, yes, the NAV is available. I'll just put the heading of closing NAV. Let's go and check in the question. 2016 is 47. That's not relevant to us. 2017 is 48. 2018 is 50. 2018 again is 46, not relevant. 45. And the last date it is turning out to be 49. Okay. So now here I know that the NAV is 45. So this divided by 45 should give me 21,607. Or in other words, it will be, okay, George, a very good point. How did I get this 10? 10 is given in the question. Maybe when I read through it, I would have skipped read it. It is given in the question. Where it's not seen here. Oh, then it's a typing mistake. It was supposed to be here. Okay, we'll make a correction there. Face value is equal to 10. Okay, that's actually given in the question. So sorry, it's not given in the handout that I have given you, but it's actually available. Okay, so now this will be 1.50x divided by 45 is equal to 21,607. Okay, so in other words, 1.50x divided by 45 is equal to 21607 minus x. Am I complicating it? I think, okay, let's try doing it this way. So what next will come up? Or wait, I can simplify the equation. I can just make 45 as a common denominator. Am I right? Or I can say 45x plus 1.5x whole divided by 45 is equal to 21607. So 46.50x is equal to 21607 into 45. 9,72,315. Therefore, x is equal to 20,910. Like this, you have to do the remaining part, friends. So take a minute's time. Okay. So here I'll get the number as 2,910. This into 10 rupee into 15 percentage will be 31365. So this divided by 45 will give you 697 units reinvested. Then like same way how I did this, you have to go a reverse working and do the remaining part. So please take 5 minutes time. First you copy down this table, then I'll show you the next page, and remaining part you're doing it yourself. Fantastic, Rahul. That's great speed. Yes, friends. So tell me, what is the answer that you get over here now? Do you get 20,910 for the first one? And just like this, you want to get the remaining part. I'll now show you the solution part, friends. So those of you who are still doing, please write down. There has been a slight alignment issue, but the answers are correct. Rahul, great job. Your answer is absolutely right. Hamza, good job. 20,000 is the opening. Cyril, great job. It's correct. This is the answer, friends. Now, in the same manner, can you please try doing the bonus plan also? I'll give you 5 minutes time. So, those of you who are unable to finish it at the pace at which I'm doing, please don't worry, the solutions are available. Alright? If I become too slow, exams nearing, we might not be able to cover a lot of questions. I'll show you the solution for bonus plan, friends. You work out yourself, but just for my satisfaction, I'll just show you the solution on the board. Try doing it yourself and then cross check with the solution. Okay. Yes, friends. So we are done with this part also. Shall we go to the next question now? Okay. Next question is a very good question on capital budgeting, friends. Okay. So here they have given you some estimates over here where they have given you the year, they have given you the uncertain cash flow, they have given you the certainty equivalent cash flow, they have also given you the certain cash flow, discount factor, and DCF is given. Hold on. Wait, I think there has been a small mistake in the question, friends. So sorry. One moment. This is a part of another question. This is not what I intended. Wait, we'll just remove this. Let me just come down. Okay, this is the question actually, friends. So sorry, ignore the first part. Okay, that was a question on certain cash flow. This is a question on sensitivity. So basically, from this data, they want you to find out the sensitivity of the projects. They have given you the initial cost, selling price is given, cost is given, year 1, year 2, year 3 volume is given, and also the discounting factor is given. All right. From this, step number 1 for us will be to calculate the NPV. So I'll write down working note. What is the question number, friends? Capital budgeting, question number 1. Okay, so I'll give a heading called as capital budgeting. Working note number 1 will be what? It will be the basic data. Okay, so here I'll find out the NPV over here directly. Calculation of NPV. Okay, so I'll put a table here, cash flow, discount factor, discounted cash flow. Now here, year 0, the initial cost is turning out to be 10 lakhs. Year 1, 20,000 units, selling price 60, cost 40, so you make a profit of 20. 20 into 20,000 will be how much? 4 lakhs. So year 1, you make 4 lakhs. Year 2, you make 6 lakhs. And year 3, you again make 6 lakhs. Are you clear with this part? And then we'll put the discounting factor as 10%. From this, we can find out the discounted cash flow. 0.909, 0.826, 0.751. 10 lakh, and here it will be 4 lakh into 0.909, 3 lakh 63,600, 4 lakh 95,600, and last one is 4 lakh 50,600. Minus 10 lakh. So you get the answer as plus 3 lakh 9,800. So NPV is positive or negative, friends? NPV is positive. If NPV is positive, should you accept the project or reject the project? So far, accept the project. Now we will have to go and check for each and every part of sensitivity. Please take a minute and write this down in your books. Alright, I'll go to the next part now. So now they're asking you to calculate the sensitivity in relation to selling price and variable cost. So what I'll do is I'll first write down the next working note as profit per unit at which NPV becomes 0. Why? Because once I get the profit per unit, it will become very easy for me to find out the selling price per unit also. It will also help me to find out the variable cost per unit also. Am I right? So here I'll write a table here, cash flow, discounting factor, discounted cash flow. Year 0, what is the investment? 10 lakhs. Let us assume the profit is X. So year 1, the volume will be 20,000 X. Year 2, it will be 30,000 X. And year 3, again, it will be 30,000 X. At a discounting factor of 10%, your NPV should turn out to be 0. Okay. Come on. Can you put these numbers? Find out at what is the value of X now, friends. Please do it yourself and tell me the answer for that. Then I will go to the next part. Fantastic. Do you get the answer as 15.27, friends? Alright. So can I say at a profit of 15.27 rupees, my NPV becomes 0. Alright. Once you get this answer, I'll go to the next working note and I'll find out sensitivity in relation to selling price. Sensitivity in relation to selling price. Okay, there I'll write down current selling price. What is the current selling price that we have over here? I think it is 60 rupees. Point number B, selling price at which NPV becomes 0. What will be the selling price at which NPV becomes 0? We have a cost of 40. Am I right? We are looking at a minimum profit of 15.27. So do you get the answer as 55.27? So what is the change that is happening over here? 60 minus 55.27, that is equal to 4.73. Okay. And what is the base from which it is happening? From 60. So what is 4.73 divided by 60? Do you get the answer as 7.88 percentage? Or the logic of 7.88 percentage is that if my selling price falls by 7.88%, my NPV becomes 0. Can you all please write down this in your books now? Right, friends, can I go to the next part? Next one, we'll write down the next working note, sensitivity in relation to cost. Sensitivity in relation to cost. Okay, so now friends, what is the current cost that we have? 40. Point number B will be what? Cost at which NPV becomes 0. So that would be 60 minus 15.27. So I think you'll get the answer as 44 point something. Am I right? Do you get the answer as 44.73? So what is the change that you have over here? 4.73. What is the base from which we are looking at? 40. Therefore, what will be the sensitivity? That will be 11.825 percentage. What is the logic of this? If my cost goes up by 11.825%, my NPV becomes 0. Okay, units. Take a minute, write this down, then we'll go to the next part. Alright friends, I'll go to the next one now. So once we are done with these two things, next they are asking for sales volume. So I'll write down the next working note heading, sensitivity in relation to sales volume. Okay. Right now what is the volume? 20, 30, 30. So when I add up these three, 20 plus 30 plus 30, I get the answer as 80,000 units. So if my units fall down from 80,000 to some particular number of units, my NPV becomes 0. Am I right? So I'll write down first working note heading, units at which NPV becomes 0. Units at which NPV becomes 0. So now tell me, year 0, what is the amount that is invested over here? 10 lakhs. Year 1, it will be 20,000. Sorry, I'll call it as 2 into 20x because we'll take the ratio of 2 is to 3 to 3. So 20 into 2x. Year 2, it will be 20 rupees profit into 3x. Year 3, it will be 20 rupees profit into 3x. Discounting factor is how much percentage? 10%. Okay. Now, can you multiply this and I should get an NPV of 0. From this, can you please work out and tell me what will be the value of x? Tell me friends, what is the answer you get? Do you get the answer as 6850? Rahul, is that the answer you get for the units? No, that should not. 7634. Yes, that is the number. Perfect. So it should be 7634. 1 minute. So when you get the answer as 7634, that would mean in year 1 it will be 7634 into 2 because we have found the value of x only, right? Into 2, that will be 15,268. Year 2, your answer would be 7634 into what? Into 3. That is 22,902. Year 3 also it will be 7634 into 3. 22,902. Total will be 61,072. Total units will be 61,072. Fine. So friends, right now what is the total number of units? 80,000. From 80,000, if it falls down to 61,072, your NPV will become 0. So what I'll do over here, I will write down the change. So the change will be 80,000 minus 61,072. That is 18,928. Then you have a base. What is the base that you have over here? Is it 80,000? So then you will be having what? Sensitivity. That will be 18,928 divided by 80,000. That will be 23.66%, which means if my volume falls by 23.66%, my NPV becomes 0. Everybody clear with this part now? Please write down and finish it off. I'll give you 2 minutes time, then we'll go to the next question. Okay? Sorry, not next question, the next requirement. We have 2 more requirements over here. All right, friends. So we are done with this part. We are done with sensitivity in relation to volume. The difficult part is over, friends. Next, you are asking initial outlay. That part is very, very easy. So I'll write down the next working note heading: sensitivity in relation to initial outlay. In relation to initial outlay. So, friends, when you do it based on initial outlay, what is the investment that they have? 10 lakhs. What is the NPV that they have? 3,09,800. Which means if the investment increases by 3,09,800, the NPV will become 0. Am I right? So what I'll do over here, I'll write down the change is going to be 3,09,800. The base is going to be 10 lakhs. Therefore, what will be the sensitivity that you will get over here? Do you get the answer as 30.98%, which means if my investment goes up by 30.98%, my NPV will become 0. Can you write down this in your books now? Right, friends, can I go to the next part now? So I think we are done with that. Last one is project lifetime. So I'll write down the next working note. Life at which NPV becomes 0. So I'll draw a table now. Year, cash flow, discount factor, discounted cash flow. Okay. Year 0, you're investing how much? 10 lakhs. Year 1, you get how much? 4 lakhs. Year 2, you get how much? 6 lakhs. Year 3, I should get some cash flow at a discount factor of 10% so that my NPV becomes 0. From that, I can find out how much should be the life in the third year so that my NPV becomes 0. Can you please put this quickly? Find out the value of X and tell me what is going to be the cash flow in the third year. Come on, friends, tell me the answer. I'm waiting for you. Do you get the answer as 1.8748 lakhs? Fantastic. Everybody, are you getting the same answer? Okay. So I'll put it over here. If my cash flow in year 3 is 1,87,483, my NPV becomes 0. So what should be my life at year 3? That would be 1,87,483 divided by 6 lakh. That will give you the proportion into 365 days. So when you do like this, what's the number of days you get over here? You get the answer as 114 days. 114 days. Okay. That means if I'll just put that over here and then you can write down, if my life falls from 3 years to 2 years plus 114 days, okay, my NPV becomes what? 0. So what is going to be my change, friends? My total change is going to be 3 years minus 2 year plus 114 days. So what is that? 3 years is 365 into 3. 2 years is 365 into 2 and 114 days. When I do, I get the number of days as 251 days. So there should be a reduction of 251 days from a base of how much? 3 years. That is 3 into 365. So what is the sensitivity that you get over here? You get the answer as 22.93 percentage, friends. So this means if my life falls by 22.93 percentage, my NPV becomes 0. Can you write down this in your books? Friends, I hope the class is comfortable. I hope you are all able to understand properly. All right, friends. Can I go to the next part now? I think you're all clear with this. Okay. So we are done with this question also. Not to worry, friends. The entire solution is available here. We have found the 3,09,800. The way we have done it exactly in the same way it's done here also. So nothing to worry. You can always cross check the solutions in the handbook that is available. Okay. I'm just doing it because I don't want me to just read the answers and finish it off. It's better we work out these heavy questions once, because once we do these heavy questions, we are able to get maximum exposure in a minimum time possible. So when you look at this, we got the sensitivity as 7.9 for selling price and 30.98 for outflow. So outflow becomes the least sensitive and selling price becomes the most sensitive. All right. Fine. Friends, next question is a beautiful question on BADA. It's a very good question on mergers and acquisitions, friends. We'll do this question, and after this question, I think, are you all comfortable to continue till 1 o'clock, or do you want a short break in between? How are you more comfortable with? One option is we can take a short break now and then we can resume, after 5 minutes. If you want, we'll take a short 5 minutes break and then resume after 5 minutes. Option two, we stretch directly till 1 o'clock. How are you more comfortable? All right. So I think Rahul and Sridevi are mentioning we can continue till 1. Fantastic. Then I'll give you a break, a lunch break, and then we'll resume with the second session. George, are you comfortable or not comfortable? No means what? Okay. I think majority are saying break at 1. So let's presume, friends. I think that it's a faster way to complete the classes. Sitting alone and doing will be difficult. So when we work as a team, it's easier for you also. Let's do the question on BADA. It's a beautiful question. They have given you the current asset, fixed asset, total, equity, retained capital, long-term debt, current liability. Now tell me, friends, in AFM, why do they provide you with the balance sheet? The only objective is to find out the net assets. So can we find out the net assets now? So I'll write down over here, working note number 1, basic data. Now this is what we are doing on mergers, correct? So in this we'll write down, so let's not call it basic data, we'll call it as net assets. So here I'll write particulars, BA Limited, and what is the second one? DA Limited. Okay, point number 8. So here I'll write down the total assets. Everyone tell me how much is the total assets that you get? 24 lakhs and 24 lakhs and 15 lakhs, correct? 24 lakhs and the other one is 15 lakhs. What about the outside liabilities? Liabilities are turning out to be 12 lakhs and 7 lakhs. Okay. From this, I can go and find out my net assets. So what will be my net assets over here? 12 lakh for the first one. It will be 8 lakh for the second one, correct? Now I'll put the number of shares so that from this shares I can find out what I can find out, the book value per share. So let's come down and see. They have given you the income statement. They have given you the equity shares also, 1 lakh and 80,000. 80,000. So you get the answer as 12 rupees per share. And here you get the answer as 10 rupees per share. I'll call this as book value per share. Alright, come on. Quickly write down this. I'll give you a minute, then we go to the next part. Fine, friends. Can I go to the next part now? Okay. So once we get that, they have given you the income statement also. Earnings after tax is given and number of equity share is given. From that, can I find out the EPS and DPS also? Okay, so I'll write down working note number 2, analysis. So we have BA Limited and then we have DA Limited. Okay, so I'll write down earnings after tax. Earnings after tax was 2,10,000, 99,000. Number of shares 1 lakh for the first one, 80,000 for the second one. So you get the EPS as how much? 2.10 for the first one and how much for the second one? 1.2375 for the second one. They have also given you the payout ratio. Am I right? So what is the payout ratio they have? 40% and the second one is 60%. From this, can I go and find out the dividend per share? Does that turn out to be 0.84 rupees per share? ₹0.7425 per share. Alright. So we get the EPS, we get the DPS, and we also have the market price over here, that is 40 rupees and it is 15 rupees. Take a quick 1 minute and write down this, friends. Shivani, have I made some mistake? No, right? Outside liabilities 3. There's a 0 missed out over here, friends. Ignore that part. Okay, right. Fine. Fine, friends. I think you're all clear with this part. So once we get this, let's come down. They're asking, assume the both companies are in the negotiation of merger, blah blah blah, etc. Decompose the share price of both the companies into EPS and PE components. Okay, so they want you to find out the PE ratio also. I think we can do that here itself. We don't have to go to the next page. We can find out the PE ratio. So how do you find out the PE ratio? MPS divided by your EPS. So do you get the answer as 19.04 times for the first one and 15 divided by 1.2375, 12.12 times for the second one, friends. Everybody clear with this part? All right. So we got the PE ratio also, and they want you to find out ROE and book value per share. We have got the book value per share. We need to now find out the ROE. Everyone tell me what is the formula for return on equity. I'll put a table, particulars. We have BA Limited and then we have DA Limited. All right. So first thing would be earnings after tax divided by equity plus reserve. That is what will give you your return on equity. So either I can take it as EPS divided by book value per share, or I can do it on a total basis. I always prefer total basis because that's more logical. Net assets is 12 lakhs and 8 lakhs. So, and the earnings after tax is turning out to be 2,10,000, 99,000. Correct? Divided by 12 lakhs, when you do, you will get the answer as 17.5% for the first one, and you will get the answer as 12.375% for the second one. Can you quickly write down this in your books now? Fine, friends. I think we are all done with this part. Can I go to the next one? So once you are done with this part, next they are asking you to estimate the future growth rates. So the next requirement over here is growth rate. Everyone tell me what is the formula for growth rate? It is going to be retention ratio versus rate of return. Okay, so I'll write down point number A will be what? Retention ratio. Now tell me friends, how do you find out the retention ratio? 1 minus the payout ratio. So we already have the dividend payout ratio over here, 40 and 60. So retention ratio will be what? 60% and 40 percentage. And the ROE we just found out now, 17.5%. Other one is what? 12.375 percentage. So from these two datas, can I go and find out the growth rate? So that will be 16.5. So you get the answer as 10.5 percentage. 4.95 percentage. Can you do this now in your books, friends? Fine, friends. So I think we are clear with this part also. Let me go to the next one now. So once you get that number, we got the growth rates also. Based on the expected operating synergies, BA estimates that intrinsic value of DA's equity will be 20 rupees per share. Okay. You are required to develop a range of justifiable exchange ratios that can be offered by BA to DA. So I'll write down the next working note. Range of justifiable exchange ratios. So here I'll draw a table, particulars. Then you have BA limited and the other one is what? DA limited. Okay. First I'll write down market price per share. So market price per share is how much? 40 for the first one, 15 for the second one. Second one is intrinsic value, that is 20 for BA is what they have told, right? So DA's equity share would be 20. So for DA, they have told intrinsic value will be 20. So that would mean the other one would be the same as market price because no other information is given. So we'll take it as 40. Then you have EPS and we also have book value per share, correct? So what was the EPS ratio that we found out? 2.1, 1.2375. 2.1, 1.2375. Okay, and last one was book value per share. I think based on book value per share, you have 12 and 10. So from this, I can now go and I can find out the exchange ratio. Just for comparison purpose, I will take it on the base of 1. So here I'll get the answer as 0.375 is to 1. Second one will be 0.5 is to 1. Third one would be 0.5892 is to 1. And the last one would be 0.83 is to 1. So which means for every 1 share of DA, BA will offer only 0.375 in the first case and 0.833 in the last case. So I'll call this as the lower limit, the least possible, and this one is what we will call it as the upper limit. Okay, can you write down this? Now book value per share is what will be preferred by DA because they would like to get more number of shares, and this will be preferred by whom? BA, because he will have to give a least number of shares. Am I right? Please quickly write down. Yes, friends. I believe you're all done writing this also. So we got the answer for this one. Now they're asking what will be the post-merger EPS based on the exchange ratio of zero point 0.4 is to 1, and what will be the EPS accretion or dilution. So basically they're asking you for gain or loss. So let's go and quickly do that. I'll write down the next working note heading, that will be post-merger EPS. Okay. So in that, point number A will be what? That will be the exchange ratio. What is the exchange ratio? Zero point 0.4 is to 1. Therefore, what will be the number of shares after merger? Already in BA, how many number of shares are outstanding? Let's go and check. You have 1 lakh shares plus 80,000 into what? 0 0.4. So do you get the answer as 1,32,000? Correct? What will be your earnings after merger? What will be your earnings after merger? 2,10,000 and 99,000. So when you add up these two, how much do you get? Do you get the answer as 3,09,000? Okay. So from this, can I go and find out how much will be my post merger EPS? Will that turn out to be 2.34 rupees per share, friends? Come on, quickly write down this, then I'll show you how to work out the gain or loss. Fine, friends. Now I'll write down the next working note heading, gain or loss. Okay. So I'll write down the next working note heading, gain or loss. So when you do this gain or loss, you are having two people over here. One is BA Limited and the other one is DA Limited. First, what will I have to write down? How much is going to be your earnings after merger minus what is going to be your earnings before merger. So earnings before merger, we already know how much is that? 2,10,000 and 99,000. After merger will be based on the number of shares. So how many shares are outstanding over here? 1 lakh. 1 lakh shares into 2.34. That will be equal to what? 2 lakh 34,000. Am I right? And what about the other one? Other one will be how many shares are there after merger? You had 80,000 shares earlier. Now I think the exchange ratio is 0.4 is to 1, correct? So we'll be getting only 32,000 shares into 2.34. Do you get the answer as 74,880? So from this, what will be your gain or loss? We'll get the answer as 2,34,000. That will be 24,000, right? 24,000 will be the gain for the first one. And 120 is the loss. It actually should be the same. They also can find out this on a per share basis. For that, I can put the number of shares after merger or I can put before merger also. Let us assume I am putting after merger share number of shares. You will get the answer as 0.4 rupees per share and 0.75 rupees per share. Instead of 0.75, if you take the denominator as 80,000, you will get a slightly different number. Both are okay. Can you write down and finish it off, friends? Fine, friends. So I think you're all clear with this part. So we have done for BA and DA. Part 1 is clear. Let's read the next requirement. Now they are asking, based on 0.4:1, assume that BA's pre-merger P ratio will continue. Find out the accretion or dilution in the market price. So they want you to find out the gain or loss based on market price. Beautiful question, friends. You are covering all the adjustments here. So next working note would be post-merger MPS. How do you find out the post-merger MPS? You take the post-merger EPS 2.34 rupees per share into the PE ratio. What was the PE ratio of the acquiring company that we found out somewhere earlier? 19.04 times. Okay, so now when you do 2.34 into 19.04 times, you get the answer as 44.5536 rupees per share. Right? Then we will write down particulars. BA Limited, and the second one is what? DA Limited. So here I'll write down market value after merger minus what? Market value before merger. This will give you the gain or it will give you the loss. Correct? So here what is the number of shares that you have? 1 lakh into 44.55, 32,000 into 44.55. Pre-merger it was 1 lakh into 40 if I am not wrong. And here it will be 80,000 into 15. Am I right? So you will get 44 lakh 55,000, 14 lakh 25,600. And down you will get the number as 40 lakhs. And here you will get the answer as 12 lakhs. Okay. So you get the number as 4,55,000, 2,25,600. Alright, perfect. That is going to be the, both are going to make gain. That is what we call it as synergy. Okay, wait, Krishnaveni, you have a doubt. Yes, you can take 80,000, Krishnaveni, nothing wrong. See, after merger, it's only 32,000. Pre-merger, it is 80,000. You can take any one of those. Both are correct. Nothing wrong. Yes, friends, so we are done with this part also. Let's read the next requirement if any is left there. Fantastic. We have done. We got the net assets, we got all these, we got the exchange ratio, we also got the post-merger APS gain or loss, etc. So friends, we are done with that question also. Can we go to the next question? That is a question on business valuation. Okay, I have taught you value of any asset is nothing but it is the present value of future cash flows that the asset can actually generate. All right. So for that, what we will do right now is we will take these numbers and we'll write down the basic data. Okay. Friends, here I want you to write down the basic data yourself. It's very easy. Can you please put up this table exactly like this in your books? Fine, friends. I think you're done writing this. Now, please copy down this full table in your books. It's very, very crucial. From this table only, we can find out multiple things. Write down this table, interact, and tell me what hidden information you can find out from this table. Take 5 more minutes. Come on. Fantastic, Shivani. We can find out the KE. So, how much is the KE? Can you find out? Do the KE part on your own, KE and KD also. Yes, friends. So now tell me, did you get the KE and KD over here? Let me put those numbers on the board now so we can actually go and find out the WACC from this. They are having two phases over here. The first one is called as the high growth phase and the second one is called as the stable growth phase. So when you take the KE, I think you will get the KE using CAPM. You have to use CAPM formula, RF plus beta into RM minus RF, and KD will be taken after tax. So how much is the KE that you get over here? 16.9, 9.1. If I'm not wrong, your debt equity ratio was 1:1. From this, what is your WACC that you are getting over here? Do you get the answer as 13%? Right. Same way, can you tell me for the stable growth phase also, friends? Alright, friends. So what about the second one? Do you get the KE as 14%? What about the KD after tax? Can someone tell me, please? WACC is 12%. Friends, how much was your KD after tax? Please tell me. Is it 9%? Alright, and the debt equity ratio is 2:3. Fantastic. Friends, once we get this, we have learned that value of an asset is nothing but present value of future cash flows. Am I right? So now I have to go and find out what I have to go and find out the future cash flows. How do I do that? Here, I'll put 0, 1, 2, 3, 4 and so on. I think 5 is the perpetual year. First, I will write down the revenue. Okay, so what is the revenue that you have over here? Revenue is going to be 2000 crore. And what is the EBIT that you get over here? 300 crore. So from this, I can find out the EBIT into 1 minus tax. Do you get the answer as 210 crore as EBIT into 1 minus tax? Add back depreciation. Okay, that will turn out to be how much? 200 crore less capex, that is going to be 280 crore minus. All right. So when we do this, we can find out the free cash flow. So the free cash flow will be EBIT into 1 minus tax plus depreciation minus capex minus additional working capital. So sorry, I forgot about that. Minus additional working capital. So how much is the additional working capital? 25% of turnover. So that will turn out to be 500 over here, right? So once I put that, my free cash flow for the first year will be negative. But we don't have to worry about that because we look at the future cash flows, right? Do you get the answer as minus 370? Then you get 2400, 2880, 3456, 4147.2, 4976.64. Alright. So like this, friends, remaining part you have to do it yourself. Earnings also. Wait, I think last year it is going to be a 10% growth rate for the 5th year. So this plus 10% will be 4561.92. Okay. Like this, I want you to do the remaining thing. 2 hints. One, they have told capex will be offset by way of depreciation in the 5th year. So that part I'll put it as wrong. And next thing, if it's 2400, it will be 2400 into 25%. So here it will be actually 600. minus 500. So what is the extra that you will get over here? Extra will be only 100. So that is nothing but 2400 into how much percentage? 25 percentage minus the earlier working capital. Like this, can you fill up this table on your own now? Friends, let me know once you get the answer, okay? If you want, I'll show you the solution now so that you all can just cross check and write down from here now. Yes, this is the solution. If you have any corrections, let me know. Are you all done writing, friends? Yes, friends, this is a little lengthy problem, hence I am taking it a little bit slow. Let me know if you are able to follow this and if you are able to do it. Yes. So, friends, once you get this free cash flow, then what do we have to do? We have to find out the value of the business. And value of the business is nothing but it is the present value of future cash flows that the asset can actually generate. Am I right? Okay, can I go to the next part, friends? I hope you are all done with this part. All right. So next part, this diagram will help you a lot to understand how the cash flows are growing. 4 years it is growing at 13 percentage, and the remaining fifth year it is going stable growth rate at 12 percentage with a perpetual growth of 10 percentage. All right. All right, friends. So once you're done with this, we have to find out the value of the firm. So how do you do the value of a firm? Present value of high growth cash flow first. Then you take present value of perpetual cash flow. Quickly write down this and finish it off. So we are done with a very, very heavy question, friends. Please write down. Okay, Mega, you're asking how did we get 13%? In the question it's given, right? High growth phase, the KE, the WACC, we found it as 13%. And then for the stable growth rate, we got the answer as 12%. Am I right? So that's how we normally do this problem, Mega. I hope you're clear. You have high growth phase and then you have stable growth phase. Right, friends. So we are done with that question also. Time is 12:15. Shall we go to the next question? Next question is a question on portfolio management. Okay. Now, XYZ is having substantial cash flow until surplus funds are utilized to meet the future capex likely to happen. So they have given you some data. Now tell me, if they give you the number of shares, beta is given, market price is given, dividend yield is given. From this, can I find out my total market value? Okay. So once I get the total market value, can I also find out the weights involved over here? And can I find out the overall beta? So please write down in your books working note number 1, overall beta. Write down working note number 1, overall beta. Put these numbers and try finding it out yourself. Yes, friends, let's come down and check. So, do you get the overall beta as 1.46? Apart from this, they have also found out the expected dividend also. You can put that as working note number 2. Working note number 2. Total expected dividend. Can you please write down that also in your books now? Expected total dividend. This question is a little illogical question, friends, but it keeps coming in the exam. So I thought of doing it for you. Yes, friends. So did you get the answer as 2,46,282? Next part is actually illogical. Okay, you write it down because that's how it's there in your books. But you also mention that this is illogical. What they have done is they have used the word return of the portfolio. Okay, by using this, they have used the formula of only D1 divided by P0. In reality, what should be the formula, friends? The formula should be ideally P1 minus P0 plus D1 by P0. Here they have not given that, but they have got this particular, this is what they are using as a formula. So mark this part as illogical, but please write this down. Fine, friends. Now the next part is also not very logical. What they have done is they have given another heading called as they're basically what question they're asking in the question is calculate the risk of XYZ short-term portfolio with that of the market. So it's very simple. How do you find out the risk in relation to the market? Beta. We have already got the beta as 1.46. We can just give a note that beta is 1.46, which means for every 1% change in the market, security changes by 1.46 times. Hence, it is more risky than the market over. But no, they have done it in a very different manner. They have found a new thing called as market risk implicit. Then they have used CAPM formula where they have found out beta as a balancing figure and they tell that this is the theoretical beta or this should be the beta. Then they compare 1.42 with 1.46 and they say theoretical beta 1.42, actual beta 1.46, hence actual beta is more risky. But that answer is not correct according to me, friends. That's fine, but since they have done it this way, by heart and do it in the same manner in the examination. Can you write down this in your books now? Fine, friends. So then you can just give a sentence that Since market beta is more risky, it is more riskier compared to the market. First part is over. Second part, they're asking whether XYZ should change the composition of its portfolio. Tell me, friends, how do you decide whether they should change the composition of the portfolio? Friends, it is done using alpha. What is the formula for alpha? Expected return minus required return. So here for each of the investments, they are finding the CAPM return. Alright. So they get 20.28, 29.24, 18.2, 23. Once you get this, I think this one we can put it in a different format. I'll write down the next working note heading alpha. So here I'll write situation. Write down expected return, required return, that is using CAPM, alpha, and the last column will be what? Decision. So we have four situations, situation 1, 2, 3 and 4. The expected returns are what's already found out in the question. So what is the dividend yield? They have 19.5, 24, 24, 17.5, and what is the last one? 26%. Okay. Now, what about the CAPM returns? You have got 20.28%. Then you have 29.24%. Then you have 18.2%. And what about the last one? 23. What is the formula for alpha? Expected return minus required return. So if the alpha is positive, you will buy. Alpha is negative, you will sell. Can you do the remaining part on your own, friends? So you say sell, sell, sell. So basically the alpha for the first three would be negative, is it? So negative, negative, negative. Therefore your decision will be sell, sell and sell. And what about the last one? Alpha must be positive. Therefore you are going to do buy. Everybody clear with this part now? Fine. So we are done with this question also, friends. Shall I go to the next one? Okay. Next question is also a question on portfolio management. Okay, Mr. Fed Up, that is the heading that they are giving over here. He wants to invest 520 lakhs and has approached his portfolio manager. Mr. Portfolio, the portfolio manager has advised Fed up to invest in the following manner: 60 lakhs, 80 lakhs, 100 lakhs, 120 lakhs, and 160 lakhs. Beta is given 0.5, 1.8, 1.2, and 1.5. You are required to advise Mr. Fed up in regarding to the following using CAPM. So, friends, point number one, since they have given you the amount and the beta, can you also find out the weights over here? And once you get the weights, can you find out what will be the beta into weight? Please do that on your own. Tell me, friends, what is the answer for the overall beta that you get over here? Yes, friends, what is the overall beta you get over here? Can someone please help me out? If you have got the answer. Yes, friends, if these classes are being useful to you, please do like this video. That's how the YouTube algorithm works. So please help me out with that also. Fine. So do you get the answer as 1.104? Fantastic. Okay. Perfect. So everybody got the overall beta as what? 1.104. Okay. So you're required to advise using CAPM the expected return if the RF, this is 8% is what RF and RM is 10%. Alright. So now tell me, friends, considering this, can we find out the CAPM return? How will you do it? 8% plus 1.10 into RM minus RF. That will give you the overall expected return. We can also find out this separately for moderate, better, good, very good, and best also. Am I right? Perfect. So can you first do it as an overall expected return? Let us see what answer you get over there. First you do it overall, then we will do it one by one of the individual cases also. Okay. You will get the same answer ideally. Overall should be 10.208. Just double check and let me know. Perfect. So you got 10.2. Now you do it individual. That's what's given in the table. When you do individual also, you ultimately get the same answer what you get using the overall beta, friends. That's the logic that I wanted to connect to you. Please write down this now. Individual CAPM returns. Thank you so much, friends, for liking. These are all heavy questions from all the different chapters. So that in one day now we have revised bond valuation, mutual funds, we revised merger, we revised valuation. Now we are doing portfolio. Alone finishing so much will not be that much practical, friends. And I'm so happy you're watching it with full dedication. Let me know, friends, once you have got the answer. All right. So once you get this answer, you get the answer as 10.21 percentage. Okay. So now when you look at this, where are you getting a good return? When you took it from a returns point of view, best is giving you the best return. Am I right? And moderate is giving you the least return as of now. So let's read the next part of the question now. Advise replacing better with Nifty. So let's check Nifty. Have they given Nifty somewhere? Better is having a return of 10%. Nifty is also having a return of 10%. There will be no difference over there. But the main, what is the beta for better? Let's check. Beta for better is also exactly 1. And Nifty beta is also exactly 1. So that means if it's exactly the same, whether I put my money in better or whether I put my money in Nifty, it will be exactly the same because beta is always going to be 1 over here, friends. Are you all clear with this part now? Fantastic. Fantastic. So we are, I think, done with that question also. Let's go to the next question. Next question is a beautiful question. Okay, this question contains sharp index model also. I think this can be the last question, after which we'll take a break. All right, fine. So friends, in this question, they have given you the portfolio weight, they have given you the portfolio beta, expected return, and they have given you the total variance. Down they have given you the standard deviation of the market. All right. So we know that if I do standard deviation of the market into beta of portfolio, I will get the non-diversifiable risk of that particular portfolio. Okay. Then from this I can also find out my non-diversifiable variance. They have also given the total variance. So tell me, friends, what is total variance minus non-diversifiable variance? That will be diversifiable variance. Everybody clear with this part? So I'll just write down working note number 1. Analysis of total variance. Then what do we have? Diversifiable variance and non-diversifiable variance. So I'll draw a table. First column heading will be share. So you are having share is A, B, and then you have C. Then they have given you the weights also over here. Am I right? What is the weights that is given over here? 0.2, 0.5, and what is the last one? 0.3. From this weight, they have also given you the beta. What is the beta? 0.4. Then you have 0.5. Then you have 1.1. I think first what we can do, we can find out beta into weight over here. Then I will put the total variance. What is the total variance, for example? 0.015. Here I can find out NDR. How do you find out NDR? 10% into beta is nothing but 0.4. So zero point 0.1 into zero point 0.4 will be 0.04. Okay, so once I get NDR, I can also find out NDV. How do you find out NDV based on this? 0.04 square will be 0.0016. So from that you can find out DV 0.0134, and we can find out the square root of this will be DR 0.1157. Like this you are supposed to do the remaining part. Can you do this now? Gokul, you have a doubt. Just use amount invested as weights and use as it eliminates the step and one working node also. Wait, I think you're talking about the previous question, Gokul. Sorry, I missed out at that point of time. Let me just check. Why can't we take the amount as weight? So 60, 80, 140, 140, 240, 360, 360, 460, 520 is the total amount, right? How do we take the amount directly as weight? That doesn't work well. Are you talking about the multiplier method, Gokul? I normally don't use the multiplier method because it's sometimes confusing. We go by percentage. That's a logical way of telling this is the weight and this is how you find out the overall beta. That's all. Let me show you the solution, friends. They have done it individually, but you get the same number that we have got over there. You will get the overall beta as 0.66. Let everyone do this. Please type the numbers and let me know the numbers that you get, okay? Yes, friends, now tell me. So, are you getting the numbers? Let me put the numbers for the other ones also. Residual variance is what we got 0.0016. Yeah, that is non-diversifiable risk 0.0025. And what about the other one? 0.0121. Okay, so if these are the total, then I have the total variance also. Okay, with that systematic risk is what we found. Residual variance will be 0.0134, 0.0225, 0.0879. All right, so when you get this, point 0.0879 will be 0.2964. Okay, so once I get these numbers, I can now find out combined risk using two methods. First one, I can find out the combined risk using Markowitz method. So tell me, friends, under Markowitz method, what is going to be the formula? We have A, B, and C, right? So I'll put standard deviation of A, weight of A the whole square, standard deviation of B, weight of B the whole square, standard deviation of C, weight of C the whole square. Then, hold on. In the question they have given covariance AB, etc. So the next part would be weight of A into weight of B into covariance of AB. This is a refined formula. The actual formula should be standard deviation of A, weight of A, standard deviation of B, weight of B. Maybe I'll show you the second one. A, standard deviation of C, weight of A, weight of C, correlation of AC, right? Correlation is nothing but covariance AB divided AC divided by standard deviation C. Am I right? So when you put up like this and this gets cancelled, and you get the new formula as weight of A, weight of C, covariance of AC. Last one in the same way will be weight of B, weight of C, covariance of BC. Everybody clear? Can you put these numbers and try finding out yourself? So first one would be, what is the standard deviation of A that they already have got over here? Total variance is 0.015. Square root will be 0.1224. Into what is the weight of A? 0 0.2, the whole square. Second one will be 0.025 square root 0.1581, 0.1581 into 0.5 the whole square. Okay. Third one in the same way would be, how much is the total variance? 0.1. So 0.316. 0.316 into 0.3 the whole square. Then weight of A, weight of B, 0.2, 0.5 into covariance of AB. Covariance of AB is how much? 0.030. Okay. Weight of A, weight of C. So what is weight of A, weight of C? 0.2, 0.3. 0.2 into 0.3 into covariance of AC. Correct? So covariance of AC is going to be 0.02. Last one, weight of B, weight of C, 0.5, 0.3 into covariance of BC, 0.04. Come on, friends, put these numbers and tell me what is the combined risk that you get using Markowitz method. Sahil, yes, but when you're doing it like that, the formula changes as compared to what formula I normally take. I do it as standard deviation A, weight of A, the whole square. Instead, you can do it as standard variance of A plus weight of A square. You can do it like that, nothing wrong. Sahil, because in the last three cases, hold on. Yeah, 2AB is what we have done, Sahil. That formula, if you elaborate, it comes to this one. That's what I just showed you over here. See, when you look at this formula here, it's actually standard deviation of A, C, weight of A, weight of C, correlation of AC. Correlation of AC is nothing but covariance AC divided by standard deviation A, standard deviation C, correct? So this and this gets nullified, and this is a new formula that you get in place. Alright friends, I hope you are all done with this part. What is the combined risk that you get over here? I need to check in my solution book also. I think they have done it using Markowitz, and the answer that you get is 0.0363. Alright, perfect. So once we are done with Markowitz method, we have to do the same combined risk using one more method called as sharp index model. So I'll call it combined risk using what? Using sharp index model. Okay. So now when you are doing it using, hold on, Sahil, but as per matrix we will have to use AB and then BA. That is 2AB. Hold on. So you are trying to tell A square plus B square plus C square plus 2AB plus 2BC. Hold on. Okay. Thank you for correcting me over here. I should put into 2. What you said is right. It will be into 2. I forgot to put 2. Thank you so much, Sahil, for correcting me there. To multiply with 2. Only then you will get the correct answer. Thank you so much, Sahil. Thanks a lot. Right. So I think we are done with this part now, friends. So when you do it using sharp index model, in order to find out the combined variance, okay, we will have two parts to this. Part number 1 is what we will call it as non-diversifiable variance, and the other part is diversifiable variance. Under sharp index model, non-diversifiable variance will be done on an overall basis, whereas diversifiable variance will be done on an individual basis. So here the formula would be beta overall into standard deviation of market, the whole square. So how much was the beta overall that we found out earlier, friends? Did we get the beta overall as 0.66? So it will be 0.66 into 0.10 the whole square. So you'll get 0.066 the whole square. That is 0.004356. This is part 1. Okay. Then next one is diversifiable variance. Here you have three things: A, B, C. We do it individually over here. So when you do it individually, first one would be 0.1157 into, what is the weight for the first one? 0.2, correct? The whole square plus, what about for B? B, we got the answer as 0.15. So here it will be 0.15 into, what is the weight for the second one? 0.5, the whole square. And what about C? Weight is 0.3, 0.2964. 0.3, the whole square. Okay. So once you put up all these three, you will get the combined of this part. Then you should take this and this, add up, you will get the grand total. Can you put this chart, find this answer and finish it off? With this part, we are done with the first session, friends. Please write down and finish it off. Fine, friends. What is the answer you get over here? Please tell me now. Your sharp index method value formula would be 0.018428. Fantastic, friends. We are done with session number 1 and the time is 1 o'clock. Shall we take a break now? After 1 hour, we'll resume with session number 2, which will be from 2 p.m. to 4 p.m. today. So in that, we'll be covering the next question. I'm not sure which is the next question. Next, we are entering into security valuation. That's again a part of bond valuation that we're going to do it over here. And then we will move on to Forex and derivatives. All right. So stay tuned, friends. I'll see you after the break. Thank you so much. Have a nice time ahead.